As an investor, it is possible that your judgment may be clouded by some biases which may not let you take the best investment decisions for yourself. Let's talk about one such bias called the recency bias. Now, if someone were to ask you how your day was at the end of the day, you'll most likely give them an answer based on the most recent thing that happened to you before this question was asked to you. Or let's say while discussing a cricketer's performance, people often tend to gauge his or her performance based on their recent form and not their career-long statistics. This is called recency bias. Recency bias is unconsciously a big hindrance in an individual's investment journey. So what exactly is this bias? Recency bias is a psychological phenomenon where we tend to give more importance to recent events as compared to the ones that happened a while ago. Just like this bias is observed in daily life, recency bias is also very common in investing. Investors tend to give more importance to the short-term performance of a stock or a fund rather than taking into account its past performance. For instance, if an investor has invested 1 lakh rupees in a company's stock over time and after 2 years, let's say the return value is at 2 lakh rupees. But in the last 2 months, if his return falls to 1,70,000 rupees, then he will look at this investment as a loss of 30,000 rupees in 2 months and not as a gain of 1 lakh rupees over 2 years. So why is this bias harmful? Recency bias often clouds an investor's judgment and is detrimental to his or her financial being in the long term. Due to this bias, an investor may choose to stay away from a certain company's stock if there has been a recent downfall, but they may choose to forget if the company is fundamentally strong or not. So how can you avoid this bias? It is important to understand market movements, and one must understand market cycles and keep in mind that a bear cycle is usually followed by a much stronger bull cycle. An investor must keep the bigger picture in their mind and their portfolio and not be worried about short-term losses.